Last week, earnings got off to a great start when Intel, after the close on Tuesday, reported a blowout quarter with revenues up 44% and net income up 277% from the year-ago period, emboldening Intel CEO Paul Otellini to call it Intel's best first quarter ever. On Wednesday, Intel's report propelled the S&P 500 through 1,200. CSX, UPS, Google also all reported good earnings numbers last week, but it was all overshadowed by the SEC's subprime fraud suit against Goldman Sachs. This is a blockbuster case that came out on Friday afternoon and rocked financial markets, especially Goldman, which dropped something like 15% on Friday. Now, the SEC is claiming that on a synthetic CDO by the name of Abacus 2007-AC1, Goldman committed fraud against its clients by failing to reveal material information. The claim charges that Goldman allowed John Paulson, the famous hedge fund manager, to be involved in the process of selecting the securities that went into this CDO. Now, there was a middleman by the name of ACA, which managed the process of security selection and determined which securities were going to go in and which securities could not, because ACA was guaranteeing a big part of the deal. In the end, the CDO completely tanked, and the investors lost $1 billion, while Paulson made $1 billion. Now, when I was reading about this, I was pretty surprised that Goldman would participate in a transaction like this, because it's transparently unethical and it is illegal. It's to fail to disclose material information, and this clearly seems like material information. Now, what got lost in all the hoopla was a very slick sleight of hand by the SEC. That is, the SEC made their narrative as if the Abacus 2007/AC1 was a regular CDO with pieces of different mortgage-backed securities composing it. But in fact, Abacus AC1 was a synthetic CDO. Synthetic CDO doesn't actually own pieces of mortgage-backed securities or asset-backed securities or specific financial assets, but derivatives on financial assets, such as credit default swaps. Now, a key feature of a credit default swap is there has to be a buyer and there has to be a seller. That is, there has to be a party that's going long and a party that's going short. So once we understand this, it takes all the bite out of the SEC's claim, because anybody that was selling the credit default swaps that made up this synthetic CDO known as Abacus AC1 knew that there was somebody that was buying the credit default swap. They knew that there was somebody on the other side. That's the very nature of the transaction. That they didn't know that it's Paulson is irrelevant, because it's normal business procedure in these kind of transactions for the middle maker, the broker, Goldman, not to disclose the parties on either side of the trade. Unfortunately, because this deals with arcane financial instruments like CDOs and synthetic CDOs, the media has unqualifiedly swallowed the SEC's interpretation, the SEC's account of the case, and this has led to a lot of confusion in the media and amongst the public. Even usually sophisticated financial reporters have made this mistake. I've seen it in the Wall Street Journal. I've seen it on Bloomberg. And that's really unfortunate. But once the fog is cleared away, it's pretty clear that the appeal of this case to the SEC is not its legal merits, but the high profile of the parties involved. It supports pushing through financial reform legislation currently pending in Congress, and it supports the explanation that it was greedy and corrupt Wall Street banks that caused the financial crisis, which is politically expedient for a government that wants to intervene and regulate financial markets even more.